Washington is growing increasingly anxious as the US dollar, once the cornerstone of global finance, shows signs of decline. Across the world, BRICS nations are steadily selling US debt, and even long-standing allies are beginning to settle trade in China's currency. Inside the White House, officials have one mission: defend the dollar's supremacy. Yet beneath confident rhetoric lies an unsettling reality. America's most potent economic tool, its currency, is losing global confidence. For decades, the dollar underpinned trade, investment, and reserves, but that trust is fading. The dollar has dropped nearly 10% this year, while demand for U.S. bonds, the foundation of Washington's borrowing power, is weakening. From Asia to the Middle East, governments are finding ways to fund projects without U.S. approval. As President Trump struggles to restore credibility, a quiet financial shift is underway. The global system that once revolved around the dollar is beginning to diversify. In D.C., officials are increasingly focused on a single question: how to halt the slide. Trump's recent Asia tour underscores the urgency, not just about trade, but about protecting the dollar's reputation. Treasury Secretary Scott Bessent's visit to Tokyo highlighted Washington's anxiety. Rather than urging higher Japanese rates, he pressed to keep the yen from strengthening, fearing a weaker dollar would deepen the crisis. The data reinforced the concern. The dollar's 10% decline has coincided with investors moving away from U.S. bonds, long considered the safest global asset. If foreign demand for American debt continues to fall, Washington's ability to borrow cheaply, its greatest financial advantage, could evaporate. Every U.S. policy decision now appears geared toward one objective: preserving dollar dominance. But the cracks are widening. As other currencies gain momentum, the world is preparing for a post-dollar financial era. The change is visible in global debt markets. In the first 5 months of 2025, the volume of dollar-denominated bonds issued by foreign governments fell 19% to $86 billion. The first decline in 3 years. The drop signals a deeper transformation. Borrowing in dollars has become more expensive and unpredictable. With rising U.S. interest rates making repayments harder, especially for developing countries, many are questioning the logic of borrowing in a currency they don't control, and one that can be weaponized through sanctions or tariffs. For Washington, weakening demand for dollar assets poses a fiscal warning. For the rest of the world, it marks an opportunity to diversify funding sources and reduce exposure. Nations are expanding local bond markets and experimenting with regional currencies. The erosion of global trust in the greenback has opened space for an alternative: China's Yuan. Indonesia's latest move illustrates the shift. The country has issued its first offshore yuan-denominated dim sum bond, allowing investors to purchase debt in Chinese currency without involving the dollar. It's part of a broader trend. Offshore yuan bond issuance has grown 8% over the past year, reaching 720 billion yuan, about $12 billion. This expansion has accelerated since 2022, when U.S. rate hikes triggered a global dollar crunch. Now, countries are deliberately reducing dollar exposure, not because of shortages, but to gain financial independence. For Indonesia, the reasoning is strategic. The nation seeks funding stability without the risks tied to U.S. tariffs and trade policies. After Trump imposed a 19% tariff on Indonesian exports, dollar inflows shrank sharply. Despite a $14 billion trade surplus with the U.S., Jakarta committed to over $23 billion in American imports, draining its reserves. Issuing yuan bonds provides a way out, a mechanism to stabilize liquidity and reduce reliance on the dollar. Across Asia and beyond, similar shifts are unfolding. More governments and corporations are transacting, borrowing, and investing in yuan. Within the BRICS bloc and other emerging economies, the Chinese currency is gaining prominence. Offshore yuan bond sales have risen consistently for nearly 3 years, mirroring growing investor confidence in alternatives to the dollar. The balance of power is shifting. Previously high U.S. interest rates bolstered the dollar and suppressed the yuan, but trade tensions have reversed that dynamic. Analysts warn that if the yuan strengthens another 2%, nations could liquidate hundreds of billions in dollar reserves to transition toward Chinese currency. This is not a political rebellion, it's economic pragmatism. The global financial system is evolving beyond dependence on a single currency. The dollar remains powerful, but its dominance is no longer absolute. As nations seek stability outside Washington's reach, the question confronting U.S. policymakers is no longer just how to defend the dollar, but how to navigate a world that may no longer rely on it. Increasingly, the yuan is emerging not as an exception, but as a viable alternative in the global economy. In September, China's export sector surged back to strength, signaling renewed industrial momentum. Total exports rose 8.3%, led by double-digit gains in key sectors. Electric vehicles up 11%, semiconductors soaring 30%, and shipbuilding expanding by an extraordinary 40%. Each increase represents more global transactions settled in yuan rather than dollars, deepening the currency's international role. Within China, the shift is even clearer. In a single month, domestic banks sold nearly $52 billion in foreign currency as exporters and importers converted their earnings back into renminbi, a sign of growing confidence in the yuan's stability and value. Across Asia, Africa, and parts of Europe, this quiet monetary transition is accelerating. Countries are finding that trading in yuan minimizes exchange rate volatility and eliminates the cost of routing payments through the dollar. Anticipating this, Beijing has already laid the groundwork, establishing a vast network of clearing banks, currency swap lines, and cross-border payment systems that make yuan-based trade seamless. What began as small pilot projects has evolved into a sprawling financial infrastructure that anchors an expanding web of global commerce. Meanwhile, Washington's tone remains defiant. President Trump touts rising tariff revenues as evidence of success, emphasizing that the U.S. has collected an additional $31 billion in trade duties. Billion, not million, as he puts it. Customs revenues have indeed surged over 150%, reaching nearly $120 billion. But the fiscal reality beneath those figures is grim. America's budget deficit still hovers around $1.8 trillion, with spending continuing to climb across defense, Social Security, and Medicare. Most concerning is the cost of servicing the national debt. Interest payments have soared to a record $1.2 trillion, nearly 1 in every 4 federal dollars collected. That's the highest proportion in a quarter century and twice what it was just 4 years ago. Economists call this fiscal dominance, a state in which government spending dictates monetary policy, leaving little room for adjustment. Once entrenched, it's extremely difficult to reverse. Cutting defense or social programs is politically untenable amid an ongoing rivalry with China, leaving Washington with 2 choices: borrow more or let inflation erode the debt's real value. Both options weaken confidence in the dollar. Despite the temporary revenue boost from tariffs, the underlying imbalance continues to grow, pushing the U.S. closer to a fiscal breaking point. Treasury Secretary Scott Bessent and the Federal Reserve face a dilemma with no easy answer. Keep interest rates high and debt costs spiral out of control. Cut them too quickly and inflation surges back. Already, interest payments have crossed the $1 trillion threshold, testing investor patience and market stability. To manage the pressure, the Treasury is shifting towards short-term debt to exploit lower yields. A stopgap, not a solution. The Fed, meanwhile, is expected to trim rates by 1/4 point to calm markets, a move that might delay crisis but further weakens the dollar's value. If policymakers misjudge the timing, both stocks and bonds could tumble together. A scenario unseen in decades. Each rate cut buys time but chips away at the dollar's credibility, feeding a dangerous cycle of rising spending, expanding debt, and eroding trust. Ironically, the trade war meant to undermine China has instead reinforced its resilience. Successive tariffs pushed Beijing to deepen self-reliance, strengthen domestic consumption, and build alternative trade networks. The yuan's steady rise now fuels cheaper imports, higher consumer spending, and a shift toward a more balanced, consumption-driven economy. Western corporations, from Volkswagen to L'Oreal, have become heavily dependent on China's vast consumer base, in some cases generating up to 40% of their global revenue there. That dependence complicates Western unity on U.S. policy, as Europe hesitates to fully adopt Washington's confrontational stance. While the U.S. doubles down on tariffs, China is expanding influence through trade and finance. The yuan is increasingly becoming the anchor currency for growth across Asia, Latin America, and even parts of Europe. More international transactions are now conducted directly in Chinese currency, bypassing the dollar entirely. This is more than a financial adjustment. It's a geopolitical realignment. The global economic center of gravity is shifting eastward, away from confrontation and toward integration. The dollar's decline has become a question of confidence, and that confidence is gradually flowing toward nations charting their own economic course. The BRICS bloc is building independent financial systems, credit lines, and trade mechanisms, laying the foundation for a multipolar monetary order. Whether this marks the beginning of a post-dollar world or a temporary correction remains uncertain. But one thing is clear: the transformation of global finance is already underway, and its outcome will redefine economic power for decades to come.